The Graham number didn't beat the S&P 500. Over 25 years, it returned 7.01% compound annual growth rate versus 7.64% for the index, a shortfall of about 0.6% per year. $10,000 grew to $54,000 instead of $63,000, but the strategy won 14 of 25 calendar years. More wins than losses by count, yet the compound return still came up short. The losses in growth leg years were large enough to overwhelm a decade of strong gains. That gap between win rate and compound result is the real lesson here. The backtest runs from 2000 to 2024 using stocks from all major U.S. exchanges, NYSE, NASDAQ, and Amex. Market cap floor is $1 billion. That gives a 25-year window covering two major crashes, a financial crisis, a pandemic, and several bull markets. The screen is pure Graham number. Take the square root of 22.5 times trailing earnings per share times book value per share. If the stock trades below that number, it qualifies. No momentum filters. No quality overlays. No sector caps. Graham's arithmetic applied literally. Stocks are ranked by discount to their Graham number, deepest discounts first, and the portfolio holds up to 30 positions, equal weight. Rebalancing happens annually in January. A 45-day filing lag prevents look-ahead bias, so each January rebalance uses the prior fiscal year's data. If fewer than 10 stocks qualify at rebalance, the portfolio holds cash. In practice, that cash rule never triggered. The portfolio averaged 28.3 stocks per year across the full period. Transaction costs follow a size-tiered model, 0.1% for megacaps up to 0.5% for midcaps. The benchmark is the S&P 500 Total Return Index. The constant 22.5 comes from two limits Graham considered prudent. Never pay more than 15 times earnings. Never pay more than 1.5 times book value. Multiply those limits. 15 times 1.5 equals 22.5. The square root turns it into $1 figure you compare directly to the stock price. This screen concentrates in financials, industrials, and energy. Companies in these sectors carry tangible assets and positive earnings that fit the formula. Technology and healthcare rarely qualify. Their value sits in intangibles that don't appear on the balance sheet. Apple, Microsoft, Amazon won't show up in a Graham number portfolio. Their book values are small relative to their earnings power. That sector bias is the single most important thing to understand about this backtest. It determines when the strategy works and when it gets left behind. Over 25 years, the Graham number portfolio turned $10,000 into $54,404. The S&P 500 turned the same $10,000 into $63,071. That's a compound annual growth rate of 7.01% versus 7.64, negative 0.63% annual shortfall. The down capture of 69% is real. In years when the market falls, this portfolio falls about 69% as much on average. That's genuine downside protection from owning cheap stocks. The problem is the up capture of 91%. The portfolio captures most of the upside, but not all. In sustained bull markets, that gap compounds against you. The Sharpe ratio tells the story clearly. 0.234 versus 0.322 for the index. More volatility, less return per unit of risk. The extra drawdown risk at negative 44% versus negative 35% for the S&P didn't come with enough compensation, but the year-by-year data shows two distinct eras with very different outcomes. 2001 and 2002 were the strategy's finest hours. The S&P fell nearly 28% over those 2 years combined. The Graham number portfolio gained a net 14%. Stocks already priced below conservative intrinsic value had limited room to fall further. Then 2003 through 2005 delivered the payoff. 3 consecutive years of strong excess returns, 16 to 24 points each, as banks, industrials, and cyclicals recovered. 2008 broke the streak. The portfolio fell 44%, nearly 10 points worse than the index. Graham number screens load up on financials, the exact sector that collapsed in the credit crisis. Book values became unreliable overnight, but the same sectors that cratered bounced hardest. 46% in 2009, 24% in 2010. Through 2012, the strategy beat the S&P in 11 of 13 years. Then the world changed. 2013 was the inflection point. Technology companies began dominating index returns in ways Graham's framework can't capture. Amazon, Microsoft, Meta, Apple don't show up in these screens. Their absence became a structural drag. 2019 had one of the widest gaps, 3.5% versus 32% for the index. 2014 repeated the pattern and negative 23%. 2024 confirmed the problem persists at negative 16%. 2022 was the lone exception. Rate hikes punished growth stocks. The Graham portfolio fell only 8%, while the index fell 19%. But one good year in 12 doesn't overcome the accumulated shortfall. The pattern is consistent across 25 years. The Graham number wins when growth stocks are expensive and correcting. It loses when growth and tech lead the market higher. The dot-com bust was the defining moment. Financials, industrials, and energy companies overlooked during the tech boom held up while the S&P fell for 3 consecutive years. In that era, value investing looked like the only rational approach. The strategy won 11 of 13 years from 2000 to 2012. The 2013 to 2024 period was the mirror image. The S&P 500 was driven by large tech companies with high price-to-earnings and price-to-book ratios. None of them qualified. The strategy sat in financials and cyclicals while the market's best performers were exactly the stocks the formula excluded. The strategy won only 3 of 12 years in this era. The strategy's defensive character is genuine but insufficient for the U.S. market in its current structure. Down capture of 69% protected capital when markets fell, but up capture of 91% still late return in rising markets, and U.S. markets have been rising far more often than falling. Book value reliability is the core problem. Graham's formula treats book value as a proxy for liquidation value. That assumption worked in the manufacturing-heavy economy of mid-20th century America. In an economy where software, brand, and network effects drive most corporate value, book value captures an increasingly small fraction of what a business is worth. The screen selects well for banks and industrials, less well for the economy at large. The sector concentration creates correlated risk. Financials, energy, and industrials dominate every Graham number screen. These sectors are cyclically correlated. When credit markets tighten or commodity prices fall, a concentrated Graham portfolio takes outsized damage relative to a diversified index. The 2008 drawdown of negative 44% is the direct result. No quality filter means deteriorating businesses qualify. A company can have positive earnings and positive book value per share and still be heading toward bankruptcy. Adding quality overlays like return on equity above 10% or debt to equity below 1.5 would likely improve results. But that becomes a different screen from what we tested. Annual rebalancing plus a 45-day filing lag means the portfolio can hold a deteriorating stock for up to 13 months before rotating out. The full year-by-year data, charts, and backtest code are in the blog post. Link in the description. You can run the live Graham number screen at cetaresearch.com today with pre-calculated values for thousands of stocks across global exchanges. Want to see how the Graham number compares to Piotrowski or low price to earnings screens? Those backtests are coming up. Subscribe so you don't miss them.